Hi guys, this is Craig, the Options Linebacker. This is the weekend report for Sunday, February 20th. Alright, let's start off by looking at our collection of index charts and see where things are going. We have the Dow on the left-hand side, we have the transports on the right-hand side, or Dow Theory Twins. The Dow has gone absolutely parabolic. Look at this unbelievable move. Now, this is a little bit higher risk in two directions. First of all, when we see charts go like this that have a parabolic tail, they have the risk of coming down to earth in an awful hurry. But there's also the risk that people chase the move. They've been standing on the sideline for the past several months, and finally they just cannot stand it any longer. They hold their nose and they dive right in. We saw this with crude oil 3 years ago, so markets that go parabolic end up usually going a little further than people expect them to, and then they come down much faster than people expect them to as well. Now, when we talked last week, we talked about this non-confirmation with the transports because the transports had not made a higher high yet above that 52.56 level. Well, this week fixed that problem, so now there is confirmation and harmony once again in the trading universe, as the transports are now showing confirmation as well as the Dow Industrials. So while the Dow and the transports are ripping higher, what's going on with the growth stocks? Well, up to this point, the NASDAQ and the Russell 2000 have been doing well, but they didn't do so well on Friday. So what's going on here that would prevent these from blistering to the upside just like the Dow is? Before we get to that, let's do a little bit of top-down analysis starting with the Dow Industrials. So what we're going to do here is we're going to zoom out to the weekly chart and look at the larger patterns that we have in play. Now, you can see on this weekly chart, we're going all the way back to the end of 2007. We can see that final top that we had at the end of 2007 on the Dow Jones Industrials. And then from there, we started printing lower lows, lower highs. We quickly went into a bear market. What's important right now is that the Dow has cleared the last resistance point, and the next one that it's going to face is probably round number resistance at 13,000. But before we assume that it's going to grind to a stop right at 13,000, let's see how it handled 11,000. Okay, we had a throw over the top of that. Didn't necessarily use that as resistance the first time around. Let's look at 12,000. Nope. So really what we are seeing here is that the Dow is kind of ignoring that round number resistance value. Anybody placing stops above 13,000 are probably going to get run over on the way up to 13,136. So for right now, the Dow is absolutely clear sailing ahead until it hits 13,130. Understand what I'm saying here. I'm not saying it's going to go just straight up to there. I'm saying there's no overhead resistance. There's no reason why it's going to find a place for profit taking. Now let's do the same thing for the transports. Now the interesting thing about the transports is, notice where the bear market started from. It actually started from the second quarter in 2008. So while everybody else was having a difficult time heading lower, the transports threw everybody off, and I remember how difficult this was because this was a non-confirmation of epic proportions showing between the Dow and the transports. The transports were actually rallying in the face of crude oil going to all-time highs. Still can't figure that one out. Regardless, this fake out to the upside on the transports is showing all-time resistance up here at about 5,500. Now, we do have a minor resistance level at this point right there, but I really think that the transports don't chart all that well. They don't follow support and resistance as well as something like the S&P 500 does. So at this point, I'm going to say clear sailing for the transports until it does hit that 5,500 level. Now we're going to the NASDAQ Composite, and recall a couple of minutes ago I said that we were going to discuss why the NASDAQ was slowing down on Friday, and I think we found the answer for that. The 2007 highs, now this is not the all-time highs in the NASDAQ. Recall that that was made in year 2000, and we're still a long way away from that. In fact, we just got above the 38% retracement of that entire debacle. So if you're looking for potential, and NASDAQ certainly has a lot of potential for all-time highs, but right now we're focused on that 2007 high, and here it is. It's less than 30 points away. Now 30 points in the NASDAQ is less than a day's worth of work. It could find some resistance up here, and it would be a reason why the NASDAQ is starting to slow down. Now the question is, does the NASDAQ respect prior resistance? So we can look at this prior resistance from 2008, and we can see that the first time it got up to that level, we did have a minor reaction before finally plowing through that. The next level of resistance was right there, and we can see that, yes, the first time up, it did have a reaction off that level, and it did have a minor reaction again at that level. So we can see that the NASDAQ does appear to obey support and resistance. So in the meantime, we might start to see the NASDAQ having a little bit of problem up in this area. I wouldn't be surprised to see a throw over, but at least some difficulty blowing past this level on the first try. And now we get to the Russell 2000. Again, Russell on Friday was less than enthusiastic. So what's going on here? We have all-time highs on the Russell 2000 at around 856. And right now we were less than 30 points away from that as well. You can see that that's a typical week's work on the Russell higher. So it too is going to have some problems getting above that level the first time. But let's go back and see how it handles resistance from below. So the first time it came back to 2008 resistance, it did have a reaction off of there. So that's good. Plowed through it the second time though. Now the next level of resistance was right up in this area here. And difficult to say, the Russell does not chart quite as cleanly as some indices do. Appeared to have some type of reaction at that level the first time it came through. So what that tells us is that it's likely to struggle the very first time it gets up to around the 856 area. So finally, we'll finish up with the S&P 500, which is my favorite chart, and to me charts the best. And really, there's no overhead resistance that we're seeing on the S&P until we get up to around 1440. That's a long way to go. It's a very similar chart to what the Dow is showing right now. So we see that we could have some short-term difficulty with the NASDAQ and the Russell 2000. We may have some rotation into the larger cap issues because the Dow and the S&P right now just have really no overhead resistance. They can go, in this case, the S&P can go up to 1440 on a beeline and not find any overhead resistance. Now, the only thing that I'm seeing is an impediment, and I'll talk about another one in just a second here, is the 76.4% fib retracement. Now, I really don't even track this one all that much, but if we look at this entire retracement from the bear market starting in 2007, that we can see that the 23.6 provided some support on the way up. The 38.2 provided some support on the way up as well too. The 61.8% fib represented some resistance on the way up. And so we'll have to see whether or not the 76.4 does anything. The only thing that concerns me on this chart is that we're already overcooked on the weekly swing. Most of these weekly swings are showing up at about 280, 290 points, and right now we're already at 304. But this is the monthly wave 3 to the upside, and this is the weekly wave 3 to the upside. So we have a 3 on top of a 3, so it's not surprising to see that we've got a very strong wave in play here. And if you go back to December, I was saying this one really has got to get going here. If this is going to be this weekly wave 3, it's really got to get moving, and that certainly has done so in just the last month. I'm running out of time, so the chart I'll leave you with here is just the fractal energies that are showing on the weekly and the daily time frames. And unfortunately, what we're seeing is that the weekly time frame is completely exhausted, and as these red candles fall off the backside, we're going to see this even lower. So on a weekly time frame, this thing is crying out for at least a sideways consolidation, if not an outright retracement. We're also seeing this on the daily chart as well too, although I think what we're going to find is that this type of price action will slowly recharge the daily chart. But this chart's really not going to go anywhere until the weekly chart is allowed to at least coil somewhat or retrace. So that's it for this weekend, folks. Enjoy your long weekend, and we'll catch you next weekend and show you some adjustments that we're making to our strategies to account for this market. Take care.